Good morning, friends. Welcome to Share Market Winners. This is Bala signing on for Share Market Winners. Today's session is about futures and options. In this, we are going to talk primarily about option trading. The option trading is very risky one, but it is better to understand what it does, how the option trading market works. That's the basic which we are going to cover as part of this today's session. And I want you to go through the disclaimer that I'm not a SEBI registered consultant. So this is only for your education purposes. And if you do wanted to make any trading or investment advices, please feel free to discuss with your financial advisors to make any investments. Okay. Once again, welcome to Share Market Winners. We are going to discuss today about the topic option trading. Okay. So option trading is futures and option. Primarily, it comes with the name futures and options. It is all called to be a derivatives in the product. We are not directly going to buy any options. Okay, underlying assets is not being buy like as we do for any stock buying. This is here we are going to um, pay a premium and buy the asset at a premium price, and it would have a defined period in which we can hold that, so that everybody had the options to buy at a limited price. Okay, so that's the idea. The future and options are derivative products in the stock market. um, and since the value of that particular option is derived, that's why it is called as a derivative. Okay. um, there are different types of derivatives, which is an index based derivatives or stock derivatives. We will see in upcoming things. We can even invest on commodities as well. Okay, so the option is nothing but you are going to invest on the underlying asset, but not at the price of the particular share or a index, but you are going to pay a premium for that particular contract. Okay, and the premium amount will be less. Like we are going to, if we are going to take a life insurance, in that we are going to pay only a premium of that, but we are expecting a higher benefits, right? So that's how it is working. So I have given the comparison for future and option in the right hand side. You can see it is obliged to buy and sell the option contract at the strike price, which we are going to see shortly, on an expiry date. So it has a defined expiry date. So option, you are paying for a let's say you are paying a premium amount with a reduced price which has a expiry date. So unlike a share, if you buy a share, you can hold it as long as you wanted. Okay, so when the price goes, you will get that benefit of price movement, and you will make profit out of it. Here same thing, but it is bound to a obligation where the contract has a defined expiry date. Okay, so that's what we are going to see. There are two things which is mentioned here. If you look at future, you have a high risk and option as a limited risk. Both has a high risk as far as me, because I have done the I have done a lot of trading or using the option trading and futures. So with that, what I felt is it. So the future and options is nothing but the derivative products in the stock market. We are not directly investing on the underlying assets. We are going to invest with the premium amount. That is what I have so far explained. And right hand side, I have given the future and options comparison. It is always having an obligation to buy or sell with a contract period, which is having a defined expiry period. Okay, that is what we are going to. That is why it is different from the normal stock buy and sell. If the expiry date passes, then there will be a either you would have made a profit or you might be in the losses. Okay. Okay. Any questions before we move on? Okay, no questions. Then um, how do option works? Okay, these are all theory. I'm not going to talk about more theory about how the option market works and all, because it is as similar to the stock that we do for trading. Okay, but it is slightly different because we are giving a premium amount to buy the option. It has a defined expiry periods, which we talked about. Okay, so there are two types of options which we can trade. One is call option and put option. Okay, call means, what do you mean by call? You're calling. So you're expecting the price to come up. Okay, that is called call. Okay, and it also have the delta values, theta values based on there is a gamma, theta, and delta. These time values, they call it, would also have an impact on the options. Okay, that we are not going to discuss in this, but there is a two values which will have an impact on the options. One is um, intrinsic value and the time value. Together, that is what you are seeing, the option price movements. Okay, so in the option trading, you need to understand you can either buy a call or a sell a call. Similarly, in the put means you are dropping something, the price is dropping. So that is how you have to realize that. So when you are predicting that the market is going to go in a downward direction, then you can buy a put. Okay, that is what it is called as a put option. The details which I have given is to it's all available everywhere in the internet, but I would suggest you to have a look. Okay, practically, or I'm going to show how to see where the call options, how do we select the put options. That is what I am interested to show you all. Okay, if any questions, feel free to stop me. I am ready to explain in detail about that, but I'm going with my flow. Please let me know. Okay, so I have just shown you the picture here, which is nothing but the option strike price. Okay, so I have initially mentioned you that the option has a defined expiry and it does have the strike price. We are not going to take the option at this at the price in which the original underlying asset is trading. Okay, what we talked about is we are going to pay a premium for that and reserve that option. We are not going to take that into our account. Okay, it is going to be traded with the premium amount that we are paying for it, and if there is an appreciation of the premium, we are going to have a profit. If it is a depreciate in the premium, then you are going to lose, which is called as loss. Okay, so this chart which I am showing here, which is nothing but I have pulled it from the NSE website, where it is called as an option chain. Okay, this is what very important to understand. So here I have given ITM, OTM, and ATM. So these are the terms that they use for the option trading. Okay, nothing but whatever you are seeing on the left hand side, which is the call option. Okay, whatever you're seeing on the right hand side is a put option. Okay, let's go into the website and see how this is, how you can find this details. Okay, so I just opened an NSE India website. Okay, so here you have lot of informations available, but for today's content we are going to discuss about the options. At the top, you can see the option chain. That's what the derivatives which we are talking now. Okay, so options, within that you can perform the option trading on the indexes as well as to a certain degree of an uh, stocks. Okay, only a few set of F&O stocks which you can use for an option trading, as well as you can do it on the commodities as well. Okay, so if you go to the options, you can find what are the index type of options. Okay, you can see Nifty, Nifty 50, Fin Nifty, Bank Nifty, Mid Cap Nifty. These are the various options you can, these are the various things which you can use it for a F&O, futures and options. Okay, it could be a future or an option, but these are the indices which you can use it for doing an option. Okay, so if you select that particular Nifty 50, okay, Nifty is nothing but Nifty 50. What are all the stocks that you can do a future and option that is listed here? Okay, you can do it either on the index or you can do it on a particular stock also. Let's take an example. Here I am going to select Adani Enterprise. Then you can able to do an option trading on the stock as well. Okay, but we are now going to limit the session only for the indexes. Okay, so that it will be very clear. We will set up another session where we talk about how we do the stock options as well. Okay, for what you need to understand, this is having a predefined expiry dates. Okay, these expiry dates, it happens on a certain dates. For a Nifty, it is on every Thursday it will expire, and a last Thursday of a month will be a monthly expiry. So you have weekly expiries for the indices and monthly expiry. Okay, whereas for the future and option, sorry, for the futures, you don't have the weekly expiries. It is only considered to be a monthly expiries. But however it could be, you can see the dates here, the expiry dates for each of that: 27th June, 4th of July, 11th of July, 18th, 25th. It is all every Thursdays is what it is meant to. Okay, so 27th July is, sorry, June, 27th June is nothing but the expiry date of the monthly expiry of June month for a Nifty, as well as for the um, weekly expiry as well. So every week, if you have the expiry for a Nifty 50 on 6th, 13th, 20th, and 27th for the June. Similarly, if you take it for July month, on every Thursday you will have an expiry. The monthly expiry expires on 25th. Okay, how we are going to see that? We are going to do an exercise by understand from the Zerodha or FIRES. I will show you how to see that as well. Okay, so in this, you can have a call side and a put side. Call is nothing but you are expecting the price to appreciate, okay, towards the whatever you are expecting. Let's say you are expecting now the Nifty is trading around 24,500. Then you are saying the strike price is appreciating. If you are expecting it will go beyond 23,500, or you are expecting it will go beyond 23,000, 24,000, then you are expecting the market to go upper side, then it is a call side. Okay, you are expecting the market to go in the downward side, then it is called as a put side. So that is what it is listed. The center one is called as a strike price. So strike price is the prices of the Nifty, which is which you can see at a 50, the difference of a 50. Okay, initially the Nifty 50 was having a difference of 50 for each strike prices. So if you can see, now the market is trading around 23,500. The next strike price will be 23,550. Okay, so there will be a difference between these two will be 50. Okay, and one another thing, the strike price difference, or the strike price value differs. For if you go to Bank Nifty, it will be having a difference of 100. Okay, so each strike differences will be somewhere around 100. Okay, if you see 51,700, the next strike price will be 51,800. There will be a 100 price difference between each strikes. Okay, strike is nothing but the price in which you are predicting whether it can go to 51,800 or 51,600. That is the price. Okay, and right now we are seeing the Bank Nifty. It is having a 100 difference for each strikes. Okay, strikes is nothing but the underlying asset, the index, which is trading at that price, and it has a every strike levels at 100 as a difference. Okay, whereas in Nifty 50, you have a strike difference of 50. So that varies for each and every asset. Okay. Similarly, if you look at a stock option, there is something which is also different. It varies for each company to company and the based on the lot sizes. Okay. So that we will discuss. Every indices or the options, you will have a lot size. So lot size is nothing but if you buy a underlying asset at a premium price, that will have a lot. So for Nifty 50, it will be 25 is the lot size. You can buy one lot of 25 quantities. Okay. Similarly, if you take Bank Nifty, it will be 15 quantity is considered to be a one lot. With the price that it is trading, you can take it. If you are going to take a call option, you will be taking at the how the market is going to behave based on your prediction. Then the here you can see the LTP, which is nothing but the strike price, premium price for which you are going to pay for that particular strike. Okay, let's say 217.60 is the last traded price, and you are going to bid for this, means you have to calculate 15 into 217.60. That is the premium amount that you are going to pay for the stock. That we will explain. But for now, we wanted to understand this side is call, this side is put. Okay. So call side, we have the in the money, at the money, and the out of the money. Okay. So that is something, the term which you need to understand. Okay. And these values, if you can see, you can see the LTP, right? Last traded price. This LTP, you can see it will be varying or increasing towards the in the money. Okay. In the money means right now, if you can check the Nifty, Bank Nifty is a chart. Let me bring in the trading view chart so that it will be helpful to understand. I have added the indexes. So in the trading view, you can able to see the Nifty 50, which is the index, which is trading at 51,645. So that is the price in which it is trading. Okay. So 51,600. So this is the price which is trading. And if you take 60, which is very closer to 700. So this particular range, okay, the you can see a different grades, right? Different shades which you are seeing. This particular area, which is called as a at the money, because it is exactly trading near that strike price 51,700. So for that, if you wanted to buy, the premium price will be in the call side. You are expecting the market is expected to move towards 51,800. Then the price for that will be, you can see, it is that there will be a difference that will be based on the intrinsic value, what they call it. But those calculations I will show it in the next video. But for you to understand the price movement, if you can see, it is 259.50, which is the exact price of 51,700, whereas for the 51,800, it is 217 rupees 60 paise. So at the money price is higher price compared to the out of the money. Okay. So when you say out of the money, it has not reached, market has not reached level, that is called as out of the money. So whichever you can see out of the money, these prices will be slightly lesser because market has not reached that level. If you see whichever is already reached, that is called as in the money, the strike prices which is already reached. If you can see 50,900, 51,000, all these strike prices are with the premium of higher premium because the market has reached that level already. So this area is called in the money, it is already achieved. So that is called in the money. And the price which it is trading at the exactly at the price of what it is currently being traded, that is called at the money. And if you are trading at far beyond the price, then it is called as a out of the money. Same way, it will be applicable for put side as well. This side we talked about call, and this side we are talking about. So in the put side, similar thing. So if you are thinking the market, it is slightly reverse. This side, your side in the money is you are expecting the market has reached these levels already, and far beyond from the strike price of what currently traded is called as out of the money. But this side, put means you are saying the market is going to expected to go down. That is your expectation. So what is put side is, it is different. If you think 51,800 is the in the money, because it is expected, it didn't reach that level. Okay, it is call side. Put side, it is reverse. So this point, whichever is above the levels which currently being traded, is called as a in the money. Okay, so this has not reached. We are expecting the market to go down, but market is at 51,700 for the bank nifty. So this is again called as an at the money. However, the one which is beyond, so that is called as a in the money, because market has not reached, we are expecting to market to go down. So for that, this is called as an out of the money. So when we say 51,400 strike price, if you are taking a strike price to buy this 51,400, we are expecting the market to come towards this. So this is the out of the money for that. Whereas this side, market is expected to be reaching this levels. So for the put side, it is considered to be, it is in the money. Any clarifications? Any questions? Shall I proceed?
Hi, Bala.
Hi, Ravish.
Hello. Sorry, I was having one question with in the money section.
Yeah. Yes, Ravish.
So, in the in the money, in the sense like the current price, I mean, which we are bidding.
No, in the money is already traded. So it is already achieved. If you say, if you look at the call side, in the money is nothing but this is already been traded, or the market has achieved all this price, and it is right currently trading near 51,660, which is very closer to 51,700. So this portion, the above portion, which is in the money, out of the money
Hmm.
means it is trying to reach that out of the money. So it is not yet
Okay.
reached to that level in the call side.
Uh-huh.
If you look
Okay.
at
Okay.
the put
Got it.
side, you are expecting the market to come down. So it will be reverse. So here it is in the money, and this is out of the money. We are expecting market to come down. So come down in the sense it is this side. So if it is coming down, you are expecting this is the strike price, or 50,000 is the strike price which you are expecting. You are expecting the market to
Hmm.
come down. This is the out of the money for the put side.
Okay. Okay. Well, got it.
Okay, this is one of the basics that you need to understand, because when you select the strike prices, you should be aware where we are trading. Okay, if you go very far out of the money and if you take it, you may not make a profit, because as I mentioned earlier, it has the two factors affecting your strike prices. One is intrinsic value, other one is the um, time value. So time value is nothing but it is calculated with various factors like alpha, gamma, theta, delta. Okay, these four values which will influences as and when the expiry date goes on. If you are closer to the expiry, these value will decay your premium price. Okay, so that will reduce the premium amount. Okay, so that's why you are seeing the strike prices less here. Okay, premium prices are less here. If you see 52,200, it will be having a lesser premium considered to be the at the money, because we don't know whether the market will reach 52,300. So the intensity towards that 52,300 is less, because it may go. or may not go. Okay, that is why it is having a lesser premium. If it goes, this price will appreciate. That's what your profit is. Okay, so the basics which you have to understand is, you need to understand the predictions for this. You need to understand the support and resistance which we talked about in previous videos. So you need to know at this price whether the market will go upside or downside. That is one of the prediction which you need to be very clear in terms of when you're dealing with option trading. So based on that only you can take whether the market will go beyond this point or it will come down. As long as your prediction is good, you will be able to make profits out of the option trading. So what you've seen so far is, one, it has a defined expiry dates. Buy an index for an option, you are going to pay a equivalent premium, because we are not taking the underlying asset value. We are going to pay a premium for that and buy that option or sell that option. Okay, so far we have talked about call side, put side. In the call side we have in the money, at the money and out of the money. And here you wanted to understand, in the call side also you can either buy the option, you can sell the option. There are two ways you can do options. You can use call option, buy or sell. Similarly, in the put side, you can either buy the put or sell the put. So in the four ways you can able to trade this one, and you can use a different strike prices to take the option. Bala, you tell me, how if I take for 51,800, what will my profit levels? How do I calculate the profit levels? Today it is trading at 20, 217 rupees. That is the strike price. Okay. How do we know whether this 217, if the market goes beyond 51,800, what will my premium will be? Okay, for that we need to do a calculation called intrinsic value calculation. But for now I will show you that in a graph, how the price appreciations are going to be. Search by Nifty. So we talked about various other things. One is Nifty 50. We had futures and options. The first one which we are seeing here is Nifty June future. Okay, you future means you can trade it only on the monthly. Okay, on a monthly basis. So it is June future and July future. You can trade up to 3 months ahead. Okay, August future. So you can either buy or sell this future. Right now we are talking about options. Okay, so for options, how do you have to select this? You need to give the selective strike price. Okay, as we are seeing Bank Nifty, I'm just going to, based on each of the broker, it will differ. So we are talking about Nifty Bank. So here it is Bank Nifty 51,700 is the current strike price. Okay, wherever you are seeing, these are all the various strike prices, and for 51,000, 51,800. Okay, 51,800. So Bank Nifty again, one thing which I wanted to show you before I come to this portion, because you need to understand, yeah, there are various terms which we'll talked about, and the option expiry days for each of this index we talked about, it is having a expiry date which does follow a weekly expiry as well as a monthly expiry. If you talk about Nifty mid cap, it has a weekly expiry which is in here, which I have shown. If you can see here, what is the contract expiry dates for a Nifty midcap? It is a weekly expiry and monthly expiry. It happens on Monday, and Tuesday you have a Fin Nifty, that is a weekly expiry and a monthly expiry. Similarly, Wednesday Bank Nifty. So, and Thursday you have a Nifty, and Friday BSX Sensex is what another one which you can. That's again an index, right? So you can trade on the index as well. So coming back to the this one. So we are talking about bank nifty, right? So we have an expiry on every Wednesday. Weekly expiry happens on every Wednesday. So what is our weekly expiry? Which is third is our next week expiry. So third, if you see third, this is the strike price 51,800. We are expecting the price to appreciate towards 51,800. C is nothing but the call option. P is nothing but a put option. You can, if you take this one 51,800 CE, this is we are expecting out of the money, and either we can buy or sell the stock. Okay, if you let me add this so that it will be in our watch list to refer back. Okay, I have added both of that. So as far as 51,800 CE is out of the money, because right now it is trading 51,660. The it is out of the money, whereas for the put side it is what we said, it is reverse. So we are expecting the market to come down from the higher prices, so this is called as a in the money side, so that's why the premium will be higher. Okay, so how do I see, we are talking about an example, how do I see the how the profits will differ. Okay, I am taking the example of the 51,800 for bank nifty as an example, and we are seeing a or plotting that for the next weekly expiry in a 15 minutes time frame. Okay, we are thinking the market or the price of that index is expected to go towards 51,800, which is out of the money. So if you look at here, it is currently trading at 438 rupees. Okay, whereas we are we are expecting this movement is towards the positive direction. Then as long as I'm just going back to the same thing, but choosing the 3rd July, so that we will making a very relevance view from the Zerodha as well. Okay, so we are talking about 51,800. The strike price is at 438.10. Okay, so we are thinking market will go beyond 51,800. That's what the expectation. So we would expect the market to go further higher. So in the Zerodha, if you buy the strike price of 51,800, if the market is going higher and higher, the price will appreciate from this point to, let's say, if it is moving, because this will be buy at a price of, let's say we take this example, and if we are buying, as we talked about something called as lot size, it will be coming in the lot of 15 quantities is one lot. Okay, so if you buy one lot of 15 at the price of current price, whatever the market price, if you take, it will be 438.1. Okay, this into this give you the margin amount. Margin nothing but you are paying a premium for buying that call option. Okay, if it is a put option, you need to buy this one. For us call option, this is what you are trying to buy. So you are paying 438.1 for buying that. For example, today market is not there. I'm just going to demonstrate with an example. Let's say for a calculation purpose, if you are buying the premium of bank nifty 51,800 38.1. So what is the lot size? 15. So your premium amount will be this into this. So it is showing the exactly what the calculation we have done. Okay, we are thinking the price will move higher. Okay, just for calculation purposes, we are thinking the price will go because it is moving towards the 51,800. Okay, right now it is at 51,660. So we are expecting it will go towards 51,800. So if there is a price movement, let's say 100 points, okay, then this will also increase, okay. So this will move towards 480 or 500, okay. Every 1 rupee or 1 rupee equivalent movement, or every 15 point movement, you will be have an addition of 1 rupee appreciation, okay. That's how the conversion, it will be slightly different. If the momentum is more, the momentum, based on momentum, the premium price will also move higher, because it has a intrinsic value plus the time value. If the momentum is faster, you will see a appreciation of amount goes faster and higher, okay. So let's say if it is moving towards 51,800, tomorrow if it is a gap up of 100 points, then the price from here, it will go up to 48,000, sorry, so 480 rupees. So if it moves to, if the buyers are start buying at higher prices, then the price will appreciate to 48 for 480 rupees, okay. So same 15 lot, 1 lot of 15 quantities, then your profits will be calculated based on this one, okay. So and then you will be having a premium collected of 7,200, because the price is appreciating towards your prediction. So what is the profit that you can see is, you can see up to 628 rupees, that will be your profit if it is moving towards 51,800. This is just moving towards 51,800. If it crosses 51,800, your price movement, okay, your price movement will be very drastic, okay. That again, you can see it in the live sessions where I can show you, okay. um, we have 12 minutes of time left, okay. So I will try to wrap up, because how do you see the price movement is happening? You need to have some indicators added to it, so that you can take the options at a right time or a right entry point to make a profitable trades. For that, you need to add some indicators to predict and see whether it is a you can predict it in either two ways. You have to do some sort of resistance, support and resistance level analysis day before, understand how the price movement, and there are, say, various indicators which we need to use it, based on which you will be able to plot it and see whether there could be a breakout which will give you a profits, okay. So here in a Zerodha, you can add the couple of indicators which will also show the price movements: moving average, double moving average, and MACD. MACD is, we have seen this MACD in previous sessions as well, is a moving average convergence and divergence, which is what it is called. So with this movements, you can able to predict it, okay. So this is a zero line, close to zero line, and these two movements are based on 12 cross 26. Usually I will go with a slower length of 24, nothing but the candle length, okay. 24 candles, and faster length is 12 candles. It will calculate based on that. And similarly, the above side is also, we have set it for a simple moving average, that I need to um, change that as a simple to exponential moving average. These are nothing but an indicator, but first period which I'm giving 12, and the second period which I'm giving 24, same thing, nothing changed, but it is a exponential. This is simple, okay. So as and when there is a crossover happens, you can see the price appreciation from 331 rupees, okay, and it has gone to a maximum of up to 769. So this is the price movement. You can see whenever it is crossing above the zero line, and the 12 crossover 24 crossover 12 happens, you will having that movement. And if you are buying at 330 rupees, and if you are able to predict if it goes to 700, if you exit, then the profits are way higher. Let's, for a small calculation, I'm just mentioning, if it is 330, and if you are exiting at somewhere around 657, it is all in a single day which I am talking about. Okay, you would have made a profit of about 4,905 rupees. Okay, so that's the momentum. As soon as the momentum happens, the amount that is appreciate will also very fast. So the movement will be, the profits which you are going to get is also high. Similarly, if you see here, if you buy at this price, or if you buy at 657, and if it is dropped to 400 level, then there will be a loss. When you have entered at 658 rupees, considering it will go higher and higher, but the market has reversed, the premiums will decrease, so you will lose the amount. How much you would have lost? For example, you have entered at 656, let's say 656 rupees. Okay, you have entered, but it went down to 412 rupees. Then you are at the loss of 3,660 rupees. So that's how the option market plays. So when you buy at appropriate price, you will be able to make a profit. If you are taken at a higher price and if the market reverse, you will lose all your premium. By end of time, you will have entire amount of your premium will be lost. So you have, if let's say at this price you have taken at the premium of about 9,000 rupees, um, until the expiry date you can hold it. If you have taken at a margin trade of weekly expiry, then you can hold up to 3rd of July, but the premium decays every day if it is not moving towards your expected or a favorable direction. Okay, so you will lose your amount. If it is moving towards your favorable amount, if you are maintaining, if you bought it at 3,000 or 4,000 rupees, if it is moving towards 51,800, your profits will be doubling or tripling, because the premium amounts going higher and higher. Okay, with this I will stop, give you space for you to ask questions about options. Is it clear so far whatever I have explained? It's just the basics which I am talking about. There are various concepts within the option trading. Due to time constraint, we are just limiting only a topic to discuss about how do you find option trading, and what are the terminologies used in option trading, and how do you take the strike prices, how to buy or sell the strike prices. That's what we are talking so far. Any questions so far?
Suppose, Pradeep here, can you hear me?
Yeah, Pradeep.
Let's say I put one call, I put one call option, right?
Mm.
And then at the end of the week, I didn't take any action. So what will happen? So but automatically it will at the means what are the price at that day or during the end of that week, will that automatically happen or means what will happen?
Okay,
Suppose I didn't take
so
any action.
if you take a call option and the price is appreciating, okay, end of day
Mhm.
at 325, market will square off your position. Whatever the price, if you are in profit or in loss, it will be squared off. But you need to understand, you have taken a call option and it is not reaching the expected level, then the amount will go to zero. Okay, it will
Mhm.
give you whatever the amount it is showing for the that particular premium strike price. Okay, I will try to explain you with a simple example of last week. I don't know whether it will show you. 51,700, it does not have the last week expiry dates. Probably that, where we can see it from the index. Here we can see, probably if you select the last week expiry. Okay, if somebody would have chosen 51,800, okay, and if it is not reached that level, it will go to zero. Okay, but whereas in this case, it is showing some value because it is closing towards this. So their premiums would have lot more higher and gone down. Okay, but I don't have an example to show you. Okay, let's do one thing. We'll check from the same strike prices, the graph which is here. It will keep decaying. Okay, you can see it will keep if the decay will happen and it will go to zero. Okay, at last it will reach to zero.
Okay.
So if the price is
Okay.
appreciate or depreciate based on that day, whatever the price levels or the strike price levels, that will be credited back to your account. It will square off automatically. This is only in the case of your indices.
Okay.
Whereas in the stock
Okay.
options, it will be slightly different. You may tend to oblige to buy that share itself if you are in profit. You should square off before the um, expiry date or on the day of expiry at least, to ensure if you are in profit. If you don't square off, it is obliged to buy the entire lot. Whereas in the indices, it will automatically square off.
Okay. Yeah. Thank you.
Okay, I think it is only 3 minutes left. Any other questions? Okay, I think there are few terminologies used. I will share this in our WhatsApp group. You can go through that. If you have any questions, feel free to ping me. We will discuss about that topic. Okay. Once again, thanks for joining to this session. This is Bala signing off from Share Market Winners. Thank you. Please feel free to subscribe to the YouTube channel, and give your support.